Hey guys, welcome back to another edition of the Independent Sponsor Update, brought to you today by Frisch Capital Partners, and investment bankers who for the last 20-something years have been raising debt and equity for independent sponsor transactions. So Bob, welcome to the show again today. Today we want to talk about what can affect independent sponsor economics, because one of the questions we get a lot is, how can I get better economics? What affects a carrier, a promoter, a transaction fee, or a management fee? And we've really seen that there's kind of four key drivers that really influence economics. Mm-hmm. The first one is the transaction itself. The second one is the value you're bringing to the table. The third one is the amount of time you're going to invest in the deal and be involved. And the fourth one is really the amount of money you're putting in. So maybe let's just sort of unpack those a little bit so it'll be helpful for the audience today. So as we think about the first one, it's the transaction itself. So from your perspective, what are some of the things that make a transaction attractive for capital providers?
I think the number one thing would have to be that it's producing good cash flow. Nobody wants to do a deal in our market, or independent sponsors shouldn't be chasing deals where the cash flow of the company is suspect. Mm-hmm. That's absolutely, you got to prove it. Now, it may be something that's a bit on a turnaround or a situation like that, but it's got to have solid cash flow. Independent sponsors aren't really, there's so many economics going for the capital providers as well as the independent sponsors that to have a turnaround makes it really hard. But to have solid cash flow of some sort makes a big difference. Absolutely.
I totally agree with that. Some of the other things that I think about are things like, is the market defensible? Is it a type of company that's a commodity business? If it's a commodity, it's going to be a tougher row to hoe versus if there's some defensibility to it. So that's another thing that people look for. Valuations that are at or below market value. Right. And we've got another video that talks about proprietary deals versus bank deals, and so I won't dig into that, but check out the video on that. But independent sponsors can do a lot to really distinguish themselves in the market by bringing proprietary or kind of off market or off mainstream type of deals to the marketplace, and so
absolutely makes a big difference. We hear it from capital providers all the time that a moat around the cash flow, around the company, around what they're doing in the business. By moat, sort of like a castle with a moat, that it's not impenetrable. It's not that there isn't competition, but whatever it is, that isn't commodity, as you pointed out, isn't something that can be easily knocked off. There's real sort of value in whatever they're producing, whatever they're selling, and it gets to the real idea that a capital provider says, that makes a lot of sense. It's not going to just dry up tomorrow.
Absolutely. So there's a lot of things that really can define a good company, and we won't keep digging into it, but you hopefully will get the idea at this point. There's, those types of questions are the types of things that capital providers are looking at. The second thing is really looking at what's the value you as the independent sponsor are bringing to the table. And there's a lot of ways that this can manifest itself. But some of the things that we look for are things like C-suite or operating experience, especially that's relevant to the transaction. The next one is, industry or operational vertical expertise related to the specific deal. And then also, a transaction experience or a track record executing in whatever the thesis is. So if it's a buy and build, that you've actually kind of done that type of transaction in the past or been a part of a roll-up like that. So those are some of the things that I think about as we look at what's the value that you're bringing.
Yeah, absolutely. Capital providers provide capital. They've raised a lot of money. They may be a family office. They may be a private equity shop. All sorts of things. They have the capital. What they don't often have is the expertise in an industry or with a certain company or running companies, etc., etc. They're really good. Deep pockets, have a lot of capital. But they're really, and this is where independent sponsors get really good economics and become very important, is what is the expertise, whether, as you said, it's a CEO position or other C-suite position or something where they have relevant experience in the industry, in perhaps a company or a competitor that they're buying. That makes a huge difference.
Absolutely. All right, so the third thing that we get at that affects economics is the amount of time that you're going to be involved in the company. And again, there's a big spectrum here, but kind of on one end you have people that in the market today, they're really just finders. They're not going to be involved. They don't have the expertise or the value. They're just kind of looking for fees. And look, there's nothing wrong with that, but as you get further on the spectrum, you get people that are going to be more involved. For some people, it's kind of quarterly board meeting involvement, and then you move further along and it's daily, weekly, working with the management team, but really as a member of the board. And then you move further, you actually have some independent sponsors that want to step into the C-suite, as an operator, and we work with a fair number of those folks. But those are really the things that we think of in terms of how involved are you going to be? Are you going to be working daily, weekly with the management team? Are you going to be helping execute on the thesis?
Right.
That's the things that we're looking for.
Yeah, it's so important that what you're bringing to the table is something. We've had guys that have come to us and that aren't necessarily out of the industry. They might have done a transaction in the industry. They might have been investment bankers in the industry, something along those lines. We've had guys come to us that have that sort of experience. However, they've done a lot of homework. They've done a lot of studying. We got notice a couple of minutes ago about a round trip. The guys that we helped finance their company in the fitness space are now in the process and are going to probably sell their company. That's awfully attractive. Now those guys weren't necessarily guys that had run fitness companies before, but they spent months and months studying the industry. They knew more about the industry than even some of the industry executives might have even known. And then they went after buying a company. So keep in mind, time in, as you put it, is critical. And time in doesn't necessarily mean that you, whether you're going to be on the board level afterwards or involved on a day-to-day basis at the company. It means you better be someone that knows this space really well when you get the capital providers on the phone.
Absolutely. All right, so the fourth thing is, are you putting in capital? We talked about in some of our other videos about how people get paid. We look at the transaction fee, is a way that you can roll that in and get equity in the deal. And that's nice, but capital providers oftentimes, as we talk about in some of our other videos, they're looking to see, are you going to be putting in a meaningful amount of capital? And this is something that we see can really be influential. In fact, it can even help scale your economics. So kind of the more that you're putting in, the better.
Right.
But it doesn't have to be your money. It could be friends and family. It could be, a collective group that you're bringing to the table that you're representing. But that ability to put money into the deal can directly affect your economics.
Yeah, we had an earlier video that we did that said you don't have to put money in. And we've done some deals where they don't put, the independent sponsor really just rolls a fee and doesn't put in some hard cash, for lack of a better word, into the transaction. You're absolutely right, Drew. It makes a big difference. If you're going to put in hard cash, even if it's from friends and family, and you're coming up, and what that amount is, with whatever that amount is, if it's meaningful to you and it causes pain, as we mentioned in one of our earlier videos, if you were to lose it, that's what's important to them. They want to align interests. That aligns their money with your money, and it makes a big difference. On the other hand, they're not saying it has to be XYZ dollars. They're really very flexible in listening to you about what you can or can't afford to put in.
Absolutely. Totally agree with you. So, and to recap, there's really four things that can drive or affect your economics. One is the transaction itself. How good is the opportunity? Two is what's the value you're bringing or the expertise that you and your team are bringing to the deal. Three is what's the amount of engagement and involvement you want to have in the company. And then the fourth one is how much capital are you putting into the deal. So we hope you found this video useful. And again, we're committed to helping provide the tips, tools, and techniques to help successfully get your independent sponsor deals closed. Please check out our other episodes of the Independent Sponsor Update. And thank you again, Frisch Capital, for hosting and sponsoring this event. And we look forward to seeing you at future videos. Thanks and have a good day.
Thanks.
Appreciate it.